To Jeremy to introduce today's session. Thanks, Jeremy.
Thanks, Zoe. Hello, everybody. Welcome. It's my privilege to be hosting this as it's South Africa. It's a great privilege as well to be welcoming Michael Avery to, can I say, my program, because usually that's exactly what he does to me on his programs on Classic FM. And of course, two colleagues from London, Parul and Ben. Basically, just a quick little bit of background, because we've got an hour with you, and thank you for giving us your time. We're keeping it short and sharp, and I'm sure there'll be lots of questions afterwards. So as Zoe says, feel free to either put the questions through or go onto the website later on. Basically, Brand Finance was started on the 1st of April, 25 years ago, and David Haig, the founder, he and I had worked together before that when we both worked with a group called Interbrand, and David in London and me either in London or out here. And during those 25 years, it's grown now to be the largest independent brand consultancy in the world. It is ISO registered for both brand valuation, 10661, which is the financial side of a brand, and brand evaluation, what we tend to call brand strength. And a lot of people will say it's reputation related. And today, Brand Finance is in about 20 countries around the world, as you can see. One of the big things about Brand Finance is that every year it produces, I don't know, about 70 reports, either on industry-specific sectors, and here we might be talking banking or oil and gas, insurance or whatever, and by country. So this is the report for South Africa, the top 50. You'll find that when Ben speaks, he'll talk a little bit about the methodology and the results. When Parul speaks, she'll be focusing more on the nation branding aspect and the soft power side, which she will explain to you. And once you've seen this presentation, you might like to go onto the website to download the e-brochure that we produced. Last year it was about 34 pages. This year it's over 60 pages with some fascinating commentaries in there. And also, some of you might have missed the Soft Power Summit that was held at the end of February, early this year. And one of the speakers there was South Africa's Professor Thuli Madonsela. So there is a copy of what she had to say about soft power. Now, I probably already used up my 3 or 4 minutes, so I'm going to pass over to Ben, who, as I say, will take you through the methodology and the results for the 2021 South Africa Brand Finance Top 50. Ben.
Thank you, Jeremy. So just to get us started, I thought I'd touch on why brands matter, just to give a bit of sort of perspective around brands, of course, which is, the main part of the sort of essence of what we do at Brand Finance. So on screen, you should just see some examples coming from the South African and global market, kind of around why brands matter to consumers. So some examples here are, Woolworths around quality, Capitec around things like meaning, of course, a beer brand like Castle Lager being heavily associated with national events, and then, of course, just guiding consumers to that final purchase decision. With that example of sort of Coca-Cola versus a more generic cola brand. Again, sort of looking at this in more sort of financial terms, this is basically tracking that we have done since 2008, where we've looked at the top 10 most heavily branded companies within our Global 500 study, and we've compared these against the S&P 500. And as you can see on the chart, the returns have consistently outperformed the index, which again kind of just emphasizes the point of how having such a strong and highly branded business allows you to leverage all these benefits. Of course, one of which is those returns to shareholders. Again, just looking at some of the other benefits, for the last 2 years at Brand Finance, we've done a CEO Brand Guardianship Index. During the study, we rate the top CEOs on how well they protect and nurture brand value for their respective companies. The study was first published in Davos alongside our flagship publication, the Global 500. Basically, as part of the study, we found that there was a correlation between stronger brands and executive remuneration, in that the stronger the brand, the lower the fees they had to pay for their directors. And I think, to break it down, the obvious point here is that by having a stronger brand, you're able to attract better employees. You're able to motivate your employees more, and there's just overarching benefits to the business as a result. Another study, which was conducted by Peter Field and Les Binnett in the B2B space, essentially looked at brand building versus sales activation. You can see that brands that constantly undertook brand building activities experienced significantly greater revenue improvements than brands that just undertook short-term sales activation. So this is, again, basically to emphasize the point that focusing on your brand will lead to overall impact on the bottom line on things like revenue. They did cite that sales activation is of course important, but if you don't have some sort of focus on long-term brand building, you lose a lot of that impact over the long term. And then just to finish with some general principles for brand value creation, invest in your brand. We're not only thinking about external stakeholders here. Your brand has a huge impact on internal stakeholders, such as your staff and your shareholders. I think one example in recent times has been somewhere like Amazon, where a lot has come to light on employment conditions being unsanitary, and basically that had quite a negative impact on their overall brand strength. Again, brand value is something that takes a long time to build up, and it can be diminished quite easily through corporate scandal over a very short period. And again, it should always be considered as a multi-stakeholder approach. Again, a recent example in the news was with the European Super League, where we had some of the world's biggest football clubs join this league, which obviously fell apart quite quickly when it came to light. And that was largely because they hadn't considered all their stakeholders. And as soon as the news hit fans became extremely aggressive to the idea, to the extent where clubs like Manchester United have now lost out on commercial deals, and there has been significant impact on brand value for all those clubs associated. So moving on to the top 50 most valuable brands, we'll first just quickly touch on the methodology in terms of how we come up with these valuations. Essentially, it is a four-step approach outlined on the slide. The method is known as royalty relief. It's one of the preferred methodologies for tax authorities, and it's also backed by the ISO statement 10668. And essentially, the first step is looking at what we call the brand strength index. And this is essentially a balanced scorecard approach to measure the health of a brand. We look at three key components which we recognize as what somebody purchasing a brand would look to see in the brand. For example, we would want to see a brand that is being invested in, things like marketing spend, research and development, capital expenditure. And then as a result of that investment, we'd like to see, you'd expect to see brand equity in things like high levels of familiarity, consideration for purchase, improvements in reputation, and so forth. And then finally, you'd expect through that strong brand to see overall improved performance on key financial measures such as profitability, margins, and revenue. Then essentially in the second step, we look at the royalty rate applicable to that industry, and that's done through looking at a number of agreements and looking at margins for the industry. Again, you can think of brand playing a stronger role in certain industries. A good example might be in retail, where, for example, brand plays a strong role, and perhaps in something like cement, where it's more B2B focused and it's sort of more generic, then brand perhaps is less important and hence warrants a lower royalty. We then look at the forecast revenues, of which that is then discounted to come up with the final brand valuation. Again, just to look at the brand strength index a little bit more closely, you'll see some of the measures that fall under the various core categories. Probably the main area for us to highlight is that each year we run our own bespoke market research in over 30 markets and on a number of sectors, and a large portion of the brand equity data, such as familiarity and consideration and recommendation, are all informed by this research. And again, we cover a number of brands in a number of sectors, and besides just the brand strength index, the research also informs a lot of our industry analysis and insights around brand building. So here are just some high-level results coming from our most recent wave of the research this year. So I thought familiarity would be an interesting place to start at, because if a consumer is not familiar with your brand, well then, the relationship kind of stops there. If they don't know your brand, they're not going to buy a product or service from you. So looking across all our sectors, I think, some of the brands coming out top for familiarity are perhaps what you might expect. Of course, Pick n Pay, Checkers, Spar, all from the supermarket segment and have stores throughout the country. So, are constantly get it in front of eyeballs. Vodacom, of course, again, throughout the country and all over the show. We also thought it would be good to look at financial services brands in particular. It's a highly competitive market within South Africa, where we see F&B coming out on top. Of course, Capitec and ABSA feature in there as well. Again, just sort of showing the strength of the banking brands within South Africa. Then moving on to reputation, again, looking at all sectors, an interesting result this year was seeing Checkers come out on top. I'm sure many of you are aware that Checkers started repositioning their brand in late 2019 to try and capture a segment of the high-end retail section, of which Woolworths sort of had a monopoly over for some time. And as a result, we've seen a significant increase in sales for Checkers, and consumers are responding more positively to the brand. And again, this should force Woolworths to kind of become more innovative now and respond, which is always good for the industry as a whole. We see Engine feature in there as well. Again, typically we see quite low reputation scores amongst oil and gas brands, and Engine perform strongly above the average here. So again, this is a very positive result for them. The same is said for the banking brands, where across our global study, banks, I think, rank near the bottom in terms of overall reputation when compared to other sectors. But here, all our financial services brands, including the insurance brands, are quite comfortably above the global average for reputation. Then again, just looking at the data more closely and sort of, why reputation is important and, how it can impact things like revenue and profitability. This relationship is looking at reputation versus brand consideration. Now, of course, consideration is essentially consumers saying they would consider purchasing or using your product or service. And that's ultimately what you want to see in order to drive sales. And we can tell by the relationship on this curve that there's an incredibly strong relationship between these two measures, and how having a high reputation leads to a high brand consideration, which of course will then convert to things like sales and have a hugely positive impact on the overall business. So then moving on to the top 10, these are the most valuable brands for 2021. And of course, congratulations to all those brands that have made it into the rankings this year. MTN has retained its place as the most valuable brand this year, with a value of 44.8 billion. This is largely driven by some improved perceptions around the brand, and despite a slight drop in brand value year on year, the brand still retains retains its place at the top. So otherwise, there's not a huge amount of movement within the table, as we can see. Old Mutual has gone up 1 place. Mondi has entered the top 10 for the first time. Mondi have had a serious drive around sustainability, which of course is an increasingly important issue for all businesses around the world, and they've really done well there. And as a result, we can see the brand growing quite significantly. Then again, just looking at the top 5 strongest brands, again, I'm sure these are all brands that everyone is very familiar with. Capitec resonate extremely well with consumers, and they rank first in brand strength, having shifted up from second previously. F&B are up there as well. Again, the most valuable banking brand in South Africa. Carling Black Label, of course, a very well-known beer across the country. And again, we've seen improvement in brand strength over the past year, despite a tough year for alcohol sales, for things like alcohol bans and for other reasons around COVID. And again, we've seen slight drops for Vodacom and MTN, but they still hold their positions in the top 5. Otherwise, looking at brand value by sector, we can see that banking and telecoms still dominates the overall valuations, with about 40% of total value coming from the sector. We've seen an increase in retail, as a lot of brands have benefited, and insurance also holds a large portion. Finally, we can just look at the geographic distribution of some of these brands. And for example, we can see that a huge proportion is coming from Gauteng, whilst the next comes from the Western Cape, and then a small proportion from KwaZulu-Natal. As people begin to work more remotely, it's very interesting to see how things like location branding might change. But I'm going to be handing over to our nation branding and soft power expert, Parul Soni, to go into this into a little bit more detail.
Thank you, Ben. Good afternoon, everyone. So as Ben said, in this next section, I'll be taking you through our work in the nation branding soft power space that really complements our assessments of individual brands within each country. And I'll sort of touch upon how both of these, the nation brand as well as individual corporate brands, impact each other and the relationship between them. So to start off, a bit of background about Brand Finance's expertise and our work in this space. So we've been tracking nation brands for the last over 16 years now. And to supplement the annual nation brand valuation study that we've been doing, we launched our own global soft power index research, which is essentially one of the most comprehensive research studies out there on the perceptions of different nations. This research is housed in an online interactive dashboard with over 4,000 users, including several nations and corporates who are using it to inform their communications, soft power strategies, PR, and marketing. So now, what do we actually mean by soft power? So we have conducted an extensive academic literature review, including the pioneering work of Joseph Nye, who's the founder of soft power, and the following is what summarizes what we define as soft power. So soft power is a country's ability to influence the perceptions and behaviors of various actors in the international arena through attraction and persuasion rather than coercion. So this really encompasses how you come across to people around the world, and it's what defines how people around the world feel about you, whether they want to do business with you, whether they want to live and work in your country, try your food, or even just visit your country for a holiday. The research in itself is the most inclusive of its kind out there. We cover 105 nation brands in over 100 markets where this research is conducted, and this really has given rise to a rich database of over 3 million data points. The research surveys over 75,000 respondents amongst the general public, but also a select group of specialists and influencers to try and understand how they view and rate nations on a variety of different metrics. The specialists include audiences from finance analysts, business analysts, governments, NGOs, and other leaders in different spaces. And of course, with COVID-19 being one of the most defining features of the past year, we've also added an assessment of how nations have handled COVID-19, which is likely to shape our perceptions of how we interact with nations around the world for the foreseeable future. So now what actually goes into this Global Soft Power Index assessment? So what you see on the screen is a breakdown of all of the different metrics that we take into account when we're measuring soft power. So this is an aggregation of all of these perceptions, not just looking at how well people know your nation, what your overall influence is or how reputable you are, but also perceptions on specific pillars and arenas where soft power is exercised. So, looking at the attractiveness of the nation as a place to do business, for tourism, to live, to study, state of education and science in the country, perceptions of governance, which are all very important factors for nations and businesses alike. And now, sorry, Ben, I think you might have skipped a slide. There we go. So soft power is not just viewed in isolation. It has tangible benefits that it delivers. Our preliminary analysis does suggest that a 1-point consistent increase in your soft power leads to somewhere between 5 to 10% of an increase in net FDI inflow. And that's not just the work that we've done. There's also several third-party assessments. Most recently, there's been a study by the University of Edinburgh that suggests a very similar correlation and suggests that soft power actually delivers tangible benefits to people, to businesses of that nation. And now on the next slide, if we look at some of the overall rankings, there's general stability similar to what Ben showed us earlier with the top 10 ranked brands, commercial brands. And we see that, this consistency is a common theme here as well. And that's because as with commercial brands, strength and equity in this space are also resilient. We see that the same top 10 nations are being featured except for Russia, which is now replaced by Australia. Russia has seen a little bit of reputational damage in the past year. US and China have also seen a decline, but again, I'd highlight that this is not a one-off event. For the US, for example, it's been a culmination of several internal social political events that have contributed to this. And in addition to, global pandemic, which has led to this decline. Otherwise, performance remains relatively stable. And now if we focus on how South Africa specifically has done, we see that South Africa's performance has remained relatively stable. It ranks 37th out of a total of 105 nations that we've researched. And, in fact, if we exclude some of the newer countries that we've included in our assessment on a like-for-like terms, South Africa's rank has actually improved. So that's positive news. Some of the key attributes for South Africa's performance are familiarity. It's a well-known country. People know it well. Strong influence, it ranks within the top nations in terms of how influential they are, as well as international relations, which is a key pillar for South Africa. And specifically, some of the metrics that South Africa is known for is, good relations to other countries, its leadership in sport is recognized, and also finally, business and trade, which is another key strength of South Africa, which I'll go into a little bit more detail on the next slide. Ben, if you could just move on to the next slide. Yeah. So if we move on to the business and trade pillar, which directly impacts South African brands and products and services we're trying to sell overseas, the results are quite interesting. What we see is that on ease of doing business, there's good performance here. It's it's an important factor for international customers and clients who are wanting to do business with South African companies. Future growth potential is another key area where it's a top ranking metric for South Africa. It ranks within the top 10 countries globally, and that's a big achievement. And South Africa has been featured in the top 10 along with all of the other BRICS nations. And this suggests that there's real good momentum behind the nation to capture this growth. Products and brands the world loves. Perhaps this is an opportunity for corporates to leverage their origin identity, which can lead to benefits across industry. Now, speaking of how corporate brands act as nation brand ambassadors, in our experience, there's a clear reciprocity between how corporate brands use strong national brand identities for their own purposes. And equally, corporate brands also have a huge impact on nation brands. I have two examples here on the screen. Airlines, for example, are a very classic case of how corporate brand can really further a nation's identity, its values, and promote it on the world stage. And then on the other hand, we have Volkswagen, which is, a clear example of how automobile brands in Germany have really leveraged the country's reputation in this space for their own marketing purposes. And that example really demonstrates an opportunity for some of the leading South African brands that we're discussing here today to establish stronger reputations for their sectors and nation and vice versa. In the South African context, for example, Springboks are a brand that is iconic for South Africa, and Old Mutual again has leveraged its heritage and roots in South Africa to promote themselves in newer markets. And so this reciprocal relationship, I think, is quite essential for both the nation as well as the brands within it to further their causes. And now I'll pass on to our guest speaker to share his views on contribution of South African brands to the economy.
Thank you very much, Pearl. Fascinating presentation, and certainly got me thinking about how our soft power nationally might evolve as we see this TRIPS waiver story playing out. I believe the next meeting of the WTO is next month, and along with our compatriots in BRICS in India, South Africa has been a driving force in getting developed world pharma companies to waive the TRIPS IP protection that is preventing vaccines from being reproduced. So it'll be interesting to see how that goes. And I also think, Ben, I found it quite interesting that we saw Capitec come out with such strength. They're often short sellers trying to get ahead of Capitec, and it's amazing how often on social media in particular, its clients come out in defense of Capitec, and just a good example of brand strength. Now, Jeremy, thank you for the invite, and thanks to Brand Finance as well to be able to address your webinar at the launch of what has become a really august publication into the top brands in the South African economy. And I think when you think of the benefits of South African brands to the economy, and I've entitled this The Brands and Sense, it really is something of a binary or even polarizing conversation, because for so many, the South African economy has been going nowhere over the last 10 years. And so what I thought I'd do is just go back and provide some context to the way South African brands are potentially set up to respond to COVID and the pandemic and this period. And those famous last words by Benjamin Graham, the value investor, of this time it's different. Well, this time certainly isn't different. And if we go to my next slide, Ben, the quote that I've chosen is a commonly known quote from Mark Twain about history not repeating itself, but it does rhyme. And whether it's repeating or rhyming, there's a familiar look about life in the early part of this decade. If you compare what life looked like 100 years ago, because like then, we're in the midst of a major global pandemic, certainly while not as deadly as the Spanish flu, it's been at least as disruptive because of the globalized nature of the world. And encouragingly, what we can learn from the pandemic of 100 years ago, and what many others have shown, is that life does indeed return to normal. And we may even be able to look forward to some of the years ahead with some hope that things could, in fact, rebound quite strongly and become a whole lot better. So while South Africa's economy and South African brands have had to deal the cards that they've been dealt, and that has been a very soggy economy, I do think the brands that take advantage of some of these trends that we can learn historically will be those brands that will outperform into the future. And if it sounds like a lot of wishful thinking, there are some serious names out there who are just buying into this concept of us going into another gilded age. L'Oreal, the global cosmetics group, recently predicted a roaring 20s for its business once lockdowns are over and people are actually allowed to start going out again. And it's not just L'Oreal. There's a great cover there from Bloomberg Business Week. Will these 20s roar? It is kind of a theme that is in markets at the moment, that everyone's talking about whether or not the pandemic will give way to another roaring 20s. And that period was really in reference to the hedonism of the 1920s. It followed not only the Spanish flu, but it was also the First World War. And people were just happy after the end of the World War and the end of that pandemic globally to go out again, to socialize. And Jean-Paul Agon, who's L'Oreal's chief executive, predicted a fiesta in the beauty market. He said people are just going to be happy to go out again, to socialize, to put some makeup on. And we know cosmetic sales plummeted during the pandemic because people have gone behind masks. So what we might see as people open up again is another Gilded Age. And in a similar vein, we saw social epidemiologist Nick Christakis in his new book, Apollo Arrow, talk about the profound and enduring impact of the coronavirus on the way we live. He expects to see mass rejoicing, an explosion of sexuality, a resurgence in the arts in the coming years, even though we've got some way to go to achieving herd immunity around the world. South Africa, a few steps behind everywhere else, it seems. But cleaning up the post-pandemic mess, we could see nightclubs, spectator sports, festivals, all of these things really serving to be tailwinds to economic growth. Music, art, all of these other forms of creativity that have been so hampered by the pandemic. And it's important for businesses to be mindful of these big trends as they happen. We've also seen a lot of innovation through periods of disruption. If you think back to what we saw in the 1920s, at that time, we saw the invention of things like the vacuum cleaner, the washing machine, food mixers. We saw women in large parts of the democratic developed world getting the right to vote and suffrage. We saw radio and the wireless bringing entertainment into people's homes. So what periods like this tend to do is usher in a great period of innovation as well. And I think a lot of the work that we've seen in developing the vaccines and treatments for COVID-19 are likely to be applied to a range of other illnesses. The messenger RNA technologies likely to be applied to fighting cancer, for example. And it's quite clear that we're seeing new technologies like artificial intelligence, the Internet of Things, all of these things hopefully converging to bring a myriad of benefit to our lives. Now, if we have a look at what are those big lessons from the past, if we go into the next slide, one of the big ones, and that's certainly one of the big ones in markets at the moment, and what brands and business leaders need to be aware of, is higher inflation. And even though history may not rhyme like a poem, it rhymes in the way that it gives us insights into our world. And it's really worth remembering that it wasn't all jazz and flappers and the Great Gatsby in the 1920s. There was a lot of turmoil too. We saw the Soviet Union entrenching itself. We saw Germany faced with its post-war reparations bill, then confronted by hyperinflation during the Weimar Republic years, and all of that really leading into the Great Depression, which then flowed into the Second World War. So inflation, I think higher inflation is possibly one of the leading risks that brands and companies and economies need to be aware of today. Many economists that I chat to warning that the current fiscal and monetary policies really could result in inflation in the coming years, running away from the Fed. Jay Powell in the picture there is trying to assuage markets. He says that the inflation fears and pressures that we're seeing currently are transitory, but I think only time will tell, and definitely worth keeping in mind that we do run the risk of seriously overheating the global economy with record levels of stimulus and pandemic spending still to flow into those inflation prints as we see them. The next big risk is populism and inequality. And I think it feeds into what we're seeing happen come out of the Biden administration in the US in particular. And if you go back to the 1920s, it wasn't just a period of unadulterated joy for everyone. I think economic inequality was a big problem then, as it is now. And there was a lot of policy response that was more punitive at the time. The Smoot-Hawley Act over in the US, so some limits to immigration. And I think we're seeing signs of that in the global economy now as well. And we're also seeing signs of it in the way that global tax authorities are responding to companies that are the big beneficiaries from the pandemic. Janet Yellen recently stating that we need to see a global minimum corporate tax rate, and really looking at those big tech giants, Ben, to your point earlier, Amazon and so many of the others who set up in Ireland and elsewhere and pay very little tax. And this is starting to feed into this rising inequality narrative, where we see the top 1%, as per that graph from Bloomberg, taking an ever larger slice of corporate profits and benefits from companies and brand success. So I think, in an environment where you are a steward or a custodian of a brand and you're playing on the wrong side of some of these trends, I do think it could be detrimental to your brand value in the long run. And then the third major shift and trend that we're seeing is undoubtedly climate change. And it's playing out here in South Africa in a big way as we head into COP26. We're seeing a step change in the way that governments and companies are responding to climate change. We're seeing banks here in South Africa responding to corporate action, demanding disclosure around whether or not our banks are funding coal mines. And we see a lot of concern around projects that have been awarded for South Africa's well-publicized load shedding and electricity crisis that favor gas power ships, car power ship over renewable technologies. And I think increasingly we're going to see this become a flashpoint, and one of those binary flashpoints that as a brand you certainly wouldn't want to be standing on the wrong side of. Just last week, and it bears repeating this, we saw the International Energy Agency, long a supporter of fossil fuels and also using gas as a bridging fuel, saying that the world only has one choice. We either stop developing new oil, gas and coal fields this year, or we won't meet our Paris Agreement targets and we won't hit net carbon zero emissions by 2050. And just how far we are from that, from our current reality here in South Africa, as COP26 in Glasgow rapidly approaches, I think brings that certainly into very sharp focus for brands to consider as another key risk. Now, what about the economy and the markets in all of this? Well, if you look at the 1920s, they really were a great period to live in. If you were American, indeed, if you lived in the developed world, the US economy grew by 42% over the 1920s. The Dow Jones had a compound annual growth rate of 23%. And as we know, it did end in the Great Depression, but that decade was certainly a gilded age for companies and for markets. And already we're seeing a lot of that play out in our markets today. If you look locally at the South African economy, our trade data is surprising on the upside. Our trade surplus rose in February. Our exports, our platinum group metals that we're pulling out of the ground that are rising on the back of those environmental themes, are helping alleviate some of the tax pressures that we expected to have as a result of the pandemic. SARS, the South African Revenue Service, has reported an additional 140 billion rand in tax collections ahead of its initial forecasts for the 2021 tax target year. So all of that is providing a great tailwind to an economy that has been in the doldrums for the last decade. And if you had been listening to some advisors on social media who told you to get all your assets offshore, well then how's this? You would have missed out on an equity performance on the Aussie year to date, up almost 15%. The property index up over just 20% over a one-year period. So since the pandemic started, the JSE All Share is up 36.4% and listed property up 40.3%. That's followed by bonds, which have given you 14.6%, cash, which is always pretty much trash, 4.3%, and the MSCI World of 14.8%. So significantly ahead of the world at a time when people have been really pessimistic and gloomy about South Africa. And this brings me to where corporate brands really stand to get South Africa Inc. back into the swing, if you'll forgive the very bad pun there, and where good brands are seeing increased interest from international multinationals. Most recently, We saw the Heineken Distell announcement, Heineken courting Distell and its suite of drinks brands and liquor brands. A couple of years ago, we had the 23.6 billion rand transaction, one of PepsiCo's largest acquisitions outside the US when it came and purchased Pioneer Foods. And that really is a vote of confidence in the South African economy. Yes, things were bad, but markets and business leaders are forward looking and they are starting to see the tide turn. So the question is, how do brands take advantage of that? And I think within this closed loop environment where South African corporates are going to struggle to convince shareholders that they need to go offshore again, because that's also where CEOs got burnt over the last decade. The average CEO has very limited options set in South Africa. You either buy back shares, and we're seeing a lot of that, or you delist. We're still going to see plenty of delistings as well. It's a big problem for the JSE. I think we're going to see a lot more consolidation, paying over of free cash flow as dividends to shareholders as well, and increased merger and acquisition and activity. And all of that boils down to understanding and knowing your brand strengths and your competitors' brand strengths. So I think companies are going to be at the vanguard of leaving South Africa in a better position in the next few years than what we've enjoyed over the previous 10 prior to the new administration taking over. And it was interesting to note, I've got MTN on that slide, that MTN has actually declined a little bit, but is still top of the pile. And when you look at telcos, is a very exciting business that is going beyond just being a dumb pipe, is looking at fintech, is looking at rolling out other value-added services with the new CEO, Ralph Mapita, at the helm. And I think equally, we're seeing the likes of Vodacom and Shamil Jusub announcing a partnership with Alipay and this new super app that it's developing. We're seeing brands do collaborative deals with other big brands, very often brands from the East. So it'll be interesting to see how that plays out in the South African market as well. I'm going to wrap it up as I am running out of time, but there is a flip side to all of this. I have seen brands that have failed through the pandemic, and particularly in the insurance game, those brands that chose not to pay out on business interruption cover for the hospitality and tourism businesses that were so severely hampered by COVID and still are. I do think there's going to be some lingering brand damage from that. And also what we've seen with Cricket South Africa, and chatting to the acting head of Cricket South Africa, Stavros Nicolau, the other day, he said, doing business with your BRICS compatriots, particularly from India, when they look at how shambolically your cricket runs, and they say, well, how likely are you to reform your economy? All of these things do dampen that soft power apparel that you mentioned earlier. But I'd just like to leave everyone, I'm sure you've read the quote, it's a great one from Jason Zweig from the Devil's Financial Dictionary, because we have to add a caveat to all of this. When we forecast, we really are making our assumptions on the known, some of the known unknowns as we can, but we can never know all of the unknown unknowns, to borrow from Donald Rumsfeld. So do take all of that with a pinch of salt. With that, thank you very much for listening to me and my thoughts on where we are currently through the pandemic and the opportunity set, and equally the risks for brands as we emerge from it. We've got some questions that are coming through from the Q&A and the chat box as well. Please keep them coming. I'm going to ask all of my colleagues to turn on their mics and switch on their video cameras again. And we'll go through the last 15 minutes, a bit of Q&A on exactly how this brand finance ranking was conducted. Let's go with Londiwe Buthelezi first. And the first question, maybe Ben, you can pick up on this one. He says, I find it interesting that new banks, and there are lots of digital banks that are launching in South Africa, Discovery Bank, Time Bank, we're still waiting for Michael Jordan's Bank Zero, and African Bank, given its entry into transactional banking, that none of those new digital startup banks made the list. Is it because brand equity takes time to build? And how did you do on awareness? How did they do on awareness, I should say?
Sure. So, yeah, we do actually include all of those banks within our research study each year. And I think, that the point you make in your question is definitely something to consider. Brand equity can take time to build. It's not to say that in some cases you can build it a lot quicker than others. You know, some obvious reasons would be things like marketing spend. You know, that's a quick method of bringing awareness to your brand and bringing it to market quickly. But the main reason these brands aren't making our rankings table at the moment is largely just due to scale. They're still quite small compared to the traditional brands, and you know, something like revenue is a huge input into the overall brand value calculation. So it will still take these brands some time to sort of grow their balance sheet to a level where we'll see them enter the rankings. But we are monitoring their brand strength and on measures such as awareness and consideration, and they do still lag the traditional banks. You know, your FNBs and Capitec, Standard Bank, ABSA, and the like.
Do you think that is a function, just as a follow-up question, on spend, on awareness, on ability to grab the attention of the consumer by focusing on marketing and being on all channels versus their startup competitors who might not be as well resourced at this point?
It definitely plays a role. Of course, if you've got access to a bigger war chest, so to speak, you know, that there's an immediate advantage there just through what you can invest. I think also in something like banking, it's, you know, particularly if existing clients with their current banks are quite loyal, you know, their banks have done nothing that have sort of given them any reason for concern or to want to move away. It's not necessarily a sector where we would just see sort of shifts for the sake of it. I think, you know, these new banks really have to do something to attract these competitors, give them an incentive to switch, you know, not to just wait for the current banks to kind of do something to make their existing clientele want to shift.
Jeremy, I see you sticking your hand up there.
Yeah, thanks, Michael. I just wanted to add that I'm speaking under correction, but I think both Amazon and Apple are at least 40, if not 50 years old, which I think is a shock to some people. I think, again, I'm speaking under correction. Google is about 25 years and Facebook's about 20 years. So no, those are four major brands we all talk about today. But back to the questioner's point, it does take time, as Ben has been explaining.
Parul, I'd just like to move over to the issue of soft power before we come back to another question from Londiwe. How can South African brands here use the soft power and your research and the understanding of South Africa's soft power for growing their brands and business?
Yeah, sure. So I think the first step in that is understanding how audiences in different countries operate, and, you know, in the different countries that the companies want to operate in or want to operate in, view the metrics that relate to your sector. So for example, for brands in the hospitality industry, this might be, you know, understanding perceptions of culture and heritage that will be of utmost importance. For brands in the finance sector, it's to do with perceptions around governance, you know, how easy is it to do business in your country? You know, what are the levels of corruption in the country, and, you know, the general state of infrastructure in the nation. So for pharma and healthcare brands, for example, it will be the state of science, tech, and education, and all of these factors play a big part in, you know, the perceptions that people who you want to be doing business with have. And I think the key is that customer-led insight that can allow businesses to put their best foot forward when making decisions that relate to, you know, targeting markets around the world, entering new markets. And they can really use this insight to either address misconceptions or develop the capabilities that help bridge that gap, which I think will be invaluable at a time when business leaders are really looking for guidance on how to navigate the new business environment that we find ourselves in.
And looking for opportunities. I was recently privy to a panel discussion with Business Island South Africa that was hosting a dialogue with the Entrepreneurs Organization chapter in Cape Town, and just looking at the bilateral opportunities between, at a city level, the city of Cape Town and the city of Ireland. And I think a lot of that willingness and desire to do business does also feed back into soft power. Heidi Bra is one of our Our guest today, Heidi, is from a very well-known Chief Marketing Officer from Hollard, and she wants to know whether or not brands that are not listed or that don't publish financials are included or excluded. Ben?
Sure. So, I mean, at a general rule, we would start looking at listed companies, but where we can get access to things like financial statements and other publicly available data in order to conduct the valuation, we would certainly consider including non-listed companies. So again, it just depends on what's disclosed by the company and whether we can actually include them in the rankings. And that said, if you're aware of a brand, or if perhaps it's your company, you're referring to, and you think they should be included in the rankings, please do reach out to us, and we can ensure that they are included for next year's iterations. You may in fact find that we do, of course, value a number of South African brands, some of which do not feature in the top 50. So some of the brands you might be thinking of are not featured in the report, but we do have extensive tracking on them. So again, please feel free to inquire about any of those brands, and we'd be happy to discuss those valuations with you.
And then a similar question that tacks on, but maybe Jeremy, you can respond to this one. Interesting to see, and anonymous. We're all friends here. You don't have to be anonymous, but that's fine. Interesting to see that within financial services, Old Mutual is the only insurer that features in the top 10, even though we know insurance makes a big chunk of the market, and we know by spend, and they would have expected to see Discovery or Sanlam or one of the others in that top 10. Do you have an idea as to why Old Mutual is the only insurer in the top 10 and why the others don't feature?
It's actually quite interesting when you actually add up the value of Discovery and Sanlam. Together they equal Old Mutual, which just shows you how far ahead they are. One of the key things, of course, perhaps is their footprint, which is very large, as we've seen, 14 countries around Africa. Although having said that, we would see Sanlam perhaps catching up to a degree now that they've done a big deal with North African organization. But it is interesting. Remember also that we don't feature Nando's. And one of the reasons there is because we can't get the financials. Some of you with a long memory would remember they were listed on the JSE. Then after a couple of years, they actually withdrew, and now they're a privately owned company. And even though I've spoken to their management and said, come on, we'd love to include you, they say, sorry, we can't release our financials. We're a private company. So on that basis, as Ben is saying, there are certain companies that don't get included. Also this year, you'll have noticed that SPAR has come back in because it hadn't been listed for a couple of years. And again, that depends sometimes on the availability of the financials, because at all times we try and keep the integrity. So if it's not out there publicly, and this applies to Hollard, of course, then we won't publish.
And it's a very similar struggle in deal makers as well. If you're trying to produce a private equity rankings table, I mean, you can only really rank what people are willing to reveal to you financially. And that is why it requires some form of proactive inclusion. I'm going to go back to Londiwe Butalezi's follow-up question to the earlier one. She says, also noticing that the bank ranking wasn't so much depending on the company's financial performance in the past year. For instance, Old Mutual wasn't receiving as much of new business volumes as the likes of Sanlam and Momentum in 2020, but its brand is still more valuable. Ben, can you just explain why that is? And also, did the impact of COVID-19 on business volumes or sales affect brand rankings in any meaningful way?
Sure, absolutely. So I think the first thing to bear in mind is that the valuations are forward-looking. In the, if any of you are familiar with sort of discounted cash flow valuations, we're looking at the expected future cash flows, and that forms the main basis of the valuation. Now, we use analyst forecasts, which we source from Bloomberg for each of the companies. So whilst the last historic revenue, of course, does play a role, and I'm sure, the analysts are taking that into account when they're coming up with their forecasts for the future years, the main driving force behind that valuation is those future forecasts. So, perhaps we see analysts predicting some brands to grow faster than others for various reasons. And I think otherwise, another point is around brand strength, which is a key input into brand valuation. And again, where some brands are stronger than others, they of course get the benefit of a higher brand value as a result, as essentially they are earning higher brand related revenues as a result.
Right. And I mean, it's a very logical approach if you think that markets primarily are forward-looking pricing instruments. Parul, just as we've got about a minute and a half left before we hand back to Zoe to wrap everything up, how does South Africa and how can we use our rating on the soft power index to support the growth of South Africa's tourism and export sectors and improve economic growth? Because I think that's going to be the one big challenge for South Africa emerging from COVID. There was the stigma around a particular variant that was just happened to be discovered here in South Africa. It was called then the South African variant. You chaps in the UK were very smart. You didn't call yours the UK variant. You called it the Kent variant. I think maybe we should have called ours the East London variant. But it is going to be a challenge. How do we use soft power to do that?
Yeah, absolutely. I think that's a very important question in today's context, because tourism revival is absolutely something that's front of mind for several nations, and particularly South Africa. So I think there's probably two aspects to consider here. One is, how do my target audiences for tourism see South Africa? So South Africa currently actually ranks quite high on perceptions of being a great place to visit, but perhaps there's an opportunity to better promote South African cuisine. So actually South Africa has a really strong grounding in terms of tourism perceptions to build on. The second key factor is some of the additional factors that travelers are taking into consideration and that are becoming increasingly important in a post-COVID world. And this is, how well has the country actually handled COVID-19? Do I trust its governance? Is it a safe and secure place to travel? And really, I think amplifying this messaging and amplifying the work that South Africa is doing in this space, in not just keeping the virus under control, but also its role in international relations, I think that will be key for people around the world to really gain trust and consider visiting again in a post-COVID world.
Thank you very much, Parul. Lots to think about there. Jeremy, I'm going to hand back to you to wrap up. And from me, thank you very much. Been really insightful and enjoyable listening to everyone talk about where we are. And I think COVID has certainly shifted the ground under our feet. I'm going to have to duck, though. I've got an interview coming up in 1 minute. So thanks for giving me your time. Cheers.
Thanks, Michael. You can see there the pressure of someone on television and radio. You keep to the clock all the time. I'm not going to try and sum up. I think in 60 minutes, we've covered a lot of ground. We've given you a lot to think about. And I'm sure, as I said earlier, you're going to come back to us with questions and queries, perhaps some challenges as well, and that's absolutely fine. I hope we've laid out to you in greater detail the benefits of having strong brands. And it still does surprise me that there are a lot of companies that have no idea what their brands are worth, both from the financial or the emotional point of view. So lots to think about. But as you can see, brands play a crucial role in our lives, both as a country brand and through to our personal brands. Just final words, I want to thank the team in London who've been very much to the fore of putting this all together, especially my co-director, Declan Ahern, who isn't with us today, but he headed up the team in London. Thank you, Ben and Parul, and thank you to all the comms people who've been behind this whole thing. And now, Zoe, you're going to tell us how we can follow up.
Lovely. Thank you very much, Jeremy. And just repeating Jeremy's sentiments, thank you very much to all our speakers today, Jeremy, Michael, Ben, Parul, for all your great presentations, very insightful and interesting discussions. And thank you to all of our delegates for joining us today as well. I'd like to encourage you all to complete the survey that will pop up at the end of this presentation. We really value your feedback. And just to let you know, all our webinars are available to view on the Brand Finance YouTube channel. This video recording will be uploaded very shortly. Thank you once again to all of you for joining us online for the Brand Finance South Africa 5021 launch. Please do stay tuned for future events, and if you'd like any further information on the topic discussed today or how to register for upcoming webinars, please email events@brandfinance.com. And final words, thank you so much once again to everybody, and we look forward to reconnecting with you all soon. Thank you very much.